Listen to me. I want you to sit down, take a deep breath, and really listen to what I am about to tell you. Because if you are retired, or if you are standing on the threshold of retirement looking into the future, there is one question that is keeping you up at 3 o'clock in the morning. And that question is, where do I keep my safe cash so that I never, ever run out of money? I know your fears. I hear from people just like you every single day. You worked 40, 50 years for every single dollar you have. You traded your time, your energy, and your youth to build this nest egg. And now that the paycheck from your job has stopped, the fear sets in. The market fluctuates, interest rates move up and down, inflation eats away at your purchasing power, and you are terrified of making a mistake with the money you cannot afford to lose. You are asking yourself, what bank accounts do I actually need in retirement? Should I just keep everything in a traditional checking account? Do I put it all in CDs? What about high-yield savings or money market accounts? Let me set the record straight right now. Keeping all your cash in a standard traditional checking or savings account at a big neighborhood bank earning 0.01% interest is a massive mistake. That is not safety, that is guaranteed loss to inflation. But tossing your short-term cash into volatile investments because you are desperate for yield? That is even worse. In retirement, your cash needs to serve 3 distinct purposes: absolute liquidity for your monthly bills, high earning accessibility for your emergency and cash reserves, and guaranteed growth for money you won't need for a year or two. So let's walk through the exact account types you need and how to structure them so you can sleep like a baby at night. First, you have your operating checking account. This is your hub. This is where your Social Security deposits land, where your pension or monthly IRA distributions flow into, and where your daily living expenses, groceries, utilities, and mortgage or property taxes get paid out of. But here is the rule: you do not keep years of savings in this account. You keep exactly 1 to 2 months worth of living expenses here, no more, no less. It gives you fluid liquidity without leaving excess cash sitting idle earning zero interest. Second, you need a high-yield savings account, HYSA, or a cash management account. This is where your emergency fund and your primary liquid cash buffer live. In retirement, I want you to have 1 to 2 years of living expenses in safe, liquid cash. Why? Because if the stock market takes a nosedive, you never want to be forced to sell your stocks or mutual funds at a loss just to pay your electric bill. A high-yield savings account at an online FDIC-insured institution pays you competitive interest, often 10 to 20 times what traditional brick-and-mortar banks pay, while keeping your money 100% accessible whenever you need it. Third, let's talk about money market accounts, MMAs. Do not confuse a money market account at a bank with a money market mutual fund at a brokerage firm. A bank money market account is FDIC-insured, pays a competitive variable rate, and gives you check writing or debit card privileges. If you want the higher interest rate of a savings account combined with the convenience of writing a check directly for a sudden home repair or medical bill, an MMA is a phenomenal tool in your retirement arsenal. Fourth, we have certificates of deposit, CDs. When interest rates are favorable and you have cash that you know you will not need for the next 6 months, 1 year, or 2 years, a CD locks in a guaranteed rate of return. You trade temporary liquidity for total certainty. And here is an actionable takeaway I want every single one of you to write down: the CD ladder strategy. Instead of putting $50,000 into a single 5-year CD and locking your money away, you divide that money into equal parts and open a 1-year, 2-year, 3-year, 4-year, and 5-year CD. Every single year, one CD matures, giving you guaranteed cash flow and the flexibility to roll it over at current rates or spend it if needed. Now, hear me on this crucial safety warning: FDIC and NCUA insurance limits. Up to $250,000 per depositor, per insured bank, per ownership category is protected by the federal government. If you have $400,000 in cash as an individual sitting in a single bank, you are exposed. Move funds above $250,000 to a different insured bank, or structure accounts jointly with your spouse to ensure every single dollar is 100% protected. Here is your ultimate takeaway today: stop letting your hard-earned money sit asleep in accounts that do nothing for you. Structure your cash into a clean, simple system: a primary checking account for monthly bills, a high-yield savings or money market account for your 1 to 2 year cash cushion, and a CD ladder for guaranteed future income. When you respect your money, protect your money, and put your money in the right accounts, you don't just gain interest, you gain absolute, unbroken peace of mind. And that, my friends, is what retirement is all about.